Hey guys, it's Willie. Today I want to take a look at Apple stock. Currently it's $163. Over the past year, you've seen a rise of 29% and some change. As you can see, here's a 1-year chart. Looks pretty good. Not a whole lot of volatility with Apple. You know, they're the biggest company in the world. Well, I mean, depending on the day, it seems like Apple and Microsoft go back and forth. But Apple is the biggest company in the world by market cap. I believe right now they are anyway. But today I want to take a look at their financials, look at some numbers, crunch some numbers, do some math, and come up with what we think we would want to pay for Apple and if it is a good value at its current price today. So let's switch over to the spreadsheet and see what we can figure out. Alright, so now that we're in our spreadsheet, let's first take a look at the money coming into the business. Revenue, you're seeing pretty solid growth from them. Very rarely does the revenue drop at all between years. It looks pretty steadily going upward. Net income, much the same story there. Growing pretty much in line with revenue. Free cash flow, same story there. There was this kind of a drop here. Don't know why that happened. And you'll see some drops in free cash flow. But I think you're seeing the same kind of story overall with the revenue, net income, and free cash flow growing all at about 8 to 9% a year. Shares, looking at shares, Apple has become really aggressive with buying back their shares. I really love to see that. That's a good sign that the company is putting money indirectly into their investors' pockets. It's giving us as investors larger percent ownership of the business. It's not a dividend. We're not receiving a dividend as far as cash, but dividends are very tax inefficient because they're cash. So it's actually better for the company to kind of maintain the capital and use it to buy back shares. It increases our ownership of the business, thus increasing our ownership of the cash flows and thus giving us our money back in an indirect way as compared to a dividend. Earnings per share and free cash flow per share, really good story there, growing, doing really good. You're seeing about 13.5% for those because of the 8% free cash flow and net income growth, as well as the minus 4%, 4.5% almost, of chewing up the shares. So that's good. Here are the assets of Apple. I don't usually really care about the assets all that much. It would just come down to, you know, the net debt of the company. If that's an issue, then you could look at assets. But there they are if you want to look at those. Here's the dividends for my for dividend investors. So you've seen some kind of weird stuff going on here. You saw it here. I know this is a stock split. I know what happened here. I'm assuming in here there was also a stock split or something going on. You know what? Now that I'm thinking about it, it might have been a special dividend. Seems like I remember seeing when I was putting this data in a special sort of dividend or something like that. But yeah, Apple's a really stable, good dividend paying company. So yeah, even though it jumps around, it really doesn't. It just looks like it does. Total debt of the company, $287 billion right now. You take the cash, which has been growing, except for right here recently, but you know, they're spending their money. Plus COVID happened, so I mean, yeah, spend that money to stay alive, I guess. And so you get your net debt. You know, not a huge issue. You know, $225 billion seems like it would be a problem. However, when your cash flow is, you know, $90 billion, it's not that much of a problem. ROIC, looking upwards of 20% or more. Really good, but kind of what I expect from a company like Apple operating in a tech sort of world that they are. So when we look over at our metrics, you're looking at your PE and your 5 5-year PE, those are high. Same with free cash flow, price to free cash flow numbers. Those are high. It's telling us our business is expensive. However, our other metrics here that are showing us the sort of quality of the business are screaming that Apple is a really good business, which I don't think is a stretch of the imagination. I think everybody knows that Apple is a really good business. Debt is manageable. You're seeing revenue, earnings, and free cash flow growth. They're buying back their shares, and their return on invested capital is good. So they're doing a good job taking their money and investing it, or doing a good job buying back those shares and rewarding our investors. They're growing the business, etc., etc. What I have done in the forecast, as usual, I have assigned the 15 market multiple for both the free cash flow and net income based on the average historical S&P 500 PE numbers. That's because Apple is just such a big company and such a large part of the S&P 500 that I think the average is going to apply in this case. I have assumed an 8% growth rate. I think that may be somewhat aggressive for Apple, but I'm going to give them credit for the past 10-year growth rate of 8% for free cash flow. I'm not giving them the 9% for revenue. I'm going to ignore that. I'm going to give them the 8% free cash flow. But, if they were to grow revenue at 8%, they would be doing, I think, almost $800 billion in revenue, which is higher than the highest company revenue now, which would be Walmart. I think they do about $600 billion in revenue. But I'm going to give them credit. I'm going to say 8%, be a little aggressive with Apple. Based on free cash flow, you're getting a 178.50 price target. Based on net income, you're getting a 182 roughly. Currently, it's priced at 165. We're going to average those two prices together. Call it $180 in 10 years. And then we go over to IRR. You're in at 165. You get your cash flows that you own as part of your share of the company. You're out at 180. You're looking at a 7% IRR over the next 10 years. My comments on that, I guess, would be that Apple is a large part of the S&P 500. They are, I would say they're fairly valued. I'm not going to say that they're overvalued. This seems to indicate that they're overvalued, but I don't think they'd have to fall that much to become fairly valued. But I think the growth rate, I do think it's going to be lower than the 8%. You're looking at an even lower return there. And I think this is really the reason why the S&P 500 is predicted to return less than 10% a year over the next decade, simply because these companies that are, a majority of the S&P 500 are looking beyond fully valued. I'm not going to say overvalued, but I'm going to say beyond fully valued. It's, there are companies out there that I think are overvalued, and they are much worse than this, so I'm going to call this fully valued, I guess. But yeah, I think you're looking at Apple. It's a big company, not a lot of growth left in it. If they can hit 8% like they have over the past 10 years, that would be fantastic, but you're still only seeing a 7% return. So Apple is a fantastic company. It's wonderful. I love the company. They're a really good business. However, I think the price is outside of my price range. So, but like I said, always do your due diligence. If you come up with a different number, if you think they can do 10% or 15% growth over the next 10 years, that's your conclusion that you came to based on your research. But yeah, as always, do your own due diligence, do your own research, run your own numbers. Let me know in the comments below if there's any stocks that you guys would like to see me run over. If I can, I'll look at them. But let me know what you want to see. Comment, let me know anything like that. As always, like, comment, subscribe, all that stuff that the algorithm wants me to say. And I will stop here in the video, and I will catch you guys in the next one.